For as long as complex societies have existed, there has been a quiet moment that arrives before the visible fracture. It does not announce itself with panic or collapse. It arrives as a transaction, a ledger entry, a decision made by actors who understand the system well enough to leave before it stops working for them. This moment has repeated across centuries. In imperial Rome, creditors stopped extending credit to the state long before legions failed on the frontier. In late Ming China, silver quietly exited the economy years before rebellion turned violent. In the Dutch Republic, capital drifted outward even as trade volumes remained impressive. In each case, power appeared intact on the surface. Institutions functioned. Markets cleared. Confidence was publicly performed. But beneath that performance, something more fundamental had shifted. The pattern is always economic first. Capital is patient, but it is not loyal. It does not rebel or protest. It reallocates. It moves when incentives change, when risk becomes asymmetrical, when the promise of return quietly gives way to the certainty of dilution. Long before political instability or military weakness becomes obvious, the smartest participants begin shortening duration, reducing exposure, and preparing for a different future than the one being publicly described. This is how decline actually begins, not with chaos, but with optimization, not with collapse, but with exit. The reason this pattern is so difficult to recognize in real time is precisely because it unfolds within functioning systems. Prices still move, bonds still trade, governments still borrow. The rituals of stability continue, even as the underlying logic that once sustained them erodes. Observers mistake activity for health. They confuse scale with resilience. They assume continuity because yesterday still looks like today. But history shows that continuity is not permanence. Systems do not fail when they are weakest. They fail when they are most leveraged, most confident, and most dependent on conditions that can no longer be guaranteed. They fail when trust becomes structural rather than earned, when discipline is replaced by assumption, when the future is financed by borrowing credibility from the past. Every empire that relied on external financing eventually discovered the same limit. Every reserve system learned that confidence, once strained, does not snap back. And every creditor that stayed too long paid for the privilege of believing that size alone could override arithmetic. We are living inside this moment now, not at the end, but well past the beginning. The transaction has already occurred. The exposure has already been reduced. The loss has already been accepted. What comes next is not determined by outrage or intent, but by incentives that no longer point in the same direction they once did. And once that alignment breaks, history shows there is no orderly way back. Collapse, in its true form, almost never looks like collapse at the beginning. It looks like normalization. It looks like adaptation. It looks like institutions doing what they have always done, only with slightly altered assumptions and quietly stretched constraints. The language remains calm. The data appears manageable. The public conversation focuses on resilience, reform, and temporary adjustment. Meanwhile, the system is already moving through a familiar sequence. Large-scale systemic decline follows a pattern that is remarkably consistent across time and geography. It begins with an extraordinary period of expansion. Productivity rises, trade deepens, and financial instruments evolve to support real economic growth. Credit is earned. Money functions as a facilitator rather than a substitute. Confidence is grounded in performance. At this stage, the system feels deserved. The second stage arrives when growth begins to slow, but expectations do not. Rather than accepting lower returns, the system compensates with leverage. Debt fills the gap left by declining productivity. Financial innovation accelerates, not to create new value, but to preserve the appearance of it. Risk is redistributed rather than reduced. Returns are smoothed. Volatility is suppressed. The system still functions, but it begins to rely more on engineering than output. The third stage is distortion. Asset prices decouple from underlying productivity. Consumption continues to rise even as the capacity to sustain it weakens. Incentives quietly shift away from long-term investment toward short-term optimization. Capital flows toward financial extraction rather than productive expansion. Money becomes easier to create than value. At this point, the system becomes increasingly sensitive to confidence itself. Next comes dependency. The system can no longer tolerate normalization without destabilization. Higher interest rates, reduced credit growth, or fiscal restraint all carry disproportionate consequences. Policymakers become trapped by their own interventions. Each action intended to stabilize the system increases its reliance on future intervention. Discipline is no longer optional, but it is also no longer possible. The fifth stage is divergence. Insiders adapt faster than the system they inhabit. Institutions continue to present strength, while sophisticated participants quietly reposition. Exposure shortens, duration contracts. Capital becomes more mobile. Public narratives emphasize long-term confidence, while private behavior reflects caution. This is where exits occur, not out of panic, but out of arithmetic. Finally comes irreversibility. The system reaches a point where restoring balance would require losses that are politically or socially unacceptable. Adjustments are delayed until they can no longer be managed incrementally. When the break arrives, it appears sudden, but it is merely the visible expression of years of accumulated constraint. This is why collapse feels slow until it doesn't. The early stages reward participation. The middle stages reward silence. The final stage punishes everyone who assumed the pattern would somehow resolve itself differently this time. History does not repeat because people fail to see the signs. It repeats because the signs do not appear dangerous until the system has already moved beyond the point where warning matters, and once that threshold is crossed, capital stops waiting for permission to leave. One of the clearest historical examples of this pattern unfolded not in sudden collapse, but in prolonged dominance that slowly hollowed itself out. The Roman Empire at its imperial peak. Rome's rise was not accidental. It was built on disciplined expansion, legal consistency, military efficiency, and a monetary system that initially reflected real conquest and productivity. For centuries, Roman currency was trusted because it represented tangible power. Roads connected provinces. Trade flowed freely. Taxation, while heavy, was predictable. Wealth moved through the empire at a scale no prior system had achieved, and for a time, it stayed there. But Rome's advantages carried within them the seeds of distortion. As territorial expansion slowed, the inflow of external wealth diminished. The empire had been structured around growth through conquest, not sustainability through productivity. When new lands stopped arriving, the financial logic that supported Rome's scale began to strain. Military costs remained fixed or rising. Administrative layers expanded. Consumption at the center continued, even as productive capacity at the edges weakened. Rather than contract, Rome chose monetary adaptation. Silver content in coinage was gradually reduced. What began as a subtle adjustment became a structural dependency. Debasement allowed the state to meet obligations without raising taxes beyond what the population could bear. In the short term, it preserved stability. In the long term, it eroded trust. As money lost integrity, incentives shifted. Productive investment declined. Hoarding increased. Barter returned in some regions, not because markets vanished, but because confidence in currency did. Wealth increasingly flowed through the empire without anchoring itself within it. Elites accumulated assets outside productive enterprise. Provincial economies weakened as extraction intensified. The center consumed more while producing less. Debt became implicit rather than explicit. The state owed stability to the army, subsidies to urban populations, and protection to trade networks it could no longer fully secure. These obligations were not written on ledgers, but they were binding nonetheless. Each attempt to enforce control required more resources, which required further monetary distortion. Social consequences followed predictably. Small landholders were displaced by large estates. Tax burdens became uneven. Labor incentives collapsed. Military recruitment increasingly relied on non-citizens, weakening cohesion. The empire did not fall because it lacked wealth, but because wealth no longer reinforced the system that generated it. By the time Rome faced visible political fragmentation, the economic break had already occurred generations earlier. Capital had adapted. Trade routes had shifted. Local systems had learned to function with less reliance on imperial stability. The final collapse appeared dramatic only to those who mistook longevity for permanence. Rome's story is not one of sudden ruin, but of prolonged imbalance. A system that mastered scale without mastering sustainability. A monetary framework that substituted dilution for discipline. An empire where wealth circulated endlessly, but increasingly failed to renew the foundations beneath it. And when Rome finally fractured, it did not lose its money first. It lost the confidence that money once carried. The same belief in exceptionality would reappear centuries later, in a very different system, convinced that history's constraints no longer applied. The belief that structural limits can be engineered away is not unique to ancient empires. It re-emerged with force in early modern Europe, most notably in the Dutch Republic during the 17th and early 18th centuries. At its height, the Netherlands appeared untouchable. It commanded global trade routes, dominated shipping, and pioneered financial instruments that reshaped capitalism itself. Amsterdam's markets were deep, liquid, and sophisticated. Dutch government debt was widely held not because it offered exceptional returns, but because it was trusted. The Republic had become the financial center of the world, and with that position came a powerful assumption that innovation and credibility could permanently offset material limits. For a time, that assumption seemed justified. The Dutch system monetized trade efficiency, legal reliability, and institutional discipline. Capital flowed in from across Europe. Borrowing costs fell. The state financed itself cheaply, even as military and colonial commitments expanded. The system rewarded precision, not excess. Compared to its rivals, the Dutch economy appeared modern, rational, and resilient. But beneath the sophistication, the familiar pattern reasserted itself. As competitors adopted Dutch methods, margins compressed, trade profits declined, productivity growth slowed. Rather than shrink, the financial system grew larger relative to the real economy it served. Returns increasingly depended on leverage and external flows rather than domestic expansion. The idea that this time is different became embedded in behavior. Low borrowing costs were treated as a permanent feature rather than a temporary advantage. Debt rolled forward easily. Risk felt diffuse and manageable. Confidence became self-reinforcing until it wasn't. As pressures mounted, capital did not panic. It repositioned. Dutch elites increasingly invested abroad, particularly in British debt and enterprises. The Republic remained wealthy, but that wealth became externalized. Money flowed through Amsterdam's markets without committing to Dutch productivity or infrastructure. The financial center thrived even as the underlying state weakened. Denial took the form of pride. The system pointed to its advanced institutions as proof of durability. Military inferiority was dismissed as irrelevant in a financial age. Trade dominance was assumed to be self-sustaining. By the time geopolitical reality reasserted itself, the economic foundation had already shifted. The decline was not a crash, it was a transfer. Britain absorbed capital, credibility, and eventually leadership. The Dutch Republic did not collapse into chaos. It simply ceased to matter at the scale it once had. What made this episode instructive was not the speed of decline, but its invisibility to those living inside it. Markets remained orderly, debt continued to trade, institutions functioned. But the system's role in the world had changed irreversibly. Once again, the pattern held. Innovation delayed adjustment. Confidence masked dependency. And capital, unconstrained by loyalty, exited quietly. That same quiet movement, scaled to the modern world, defines the current moment. In the modern system, the scale is larger, the instruments more complex, and the narratives more refined. But the underlying mechanics remain unchanged. The global financial order that emerged after the Second World War was built on productivity, reconstruction, and an implicit promise that the core issuer of the system's reserve asset would maintain discipline because it could afford to. For decades, that promise appeared credible. The United States combined industrial dominance, technological leadership, demographic expansion, and geopolitical reach. Its debt was not merely an obligation, it was collateral for the entire global system. Holding it was not a bet on return, but on stability. Confidence in U.S. Treasuries became embedded in regulations, reserves, and risk models worldwide. Over time, however, the structure shifted. Productivity growth slowed while financial expansion accelerated. Debt grew faster than output. Consumption remained strong, increasingly funded not by income growth, but by credit expansion and asset appreciation. The system adapted by normalizing what had once been extraordinary. Persistent deficits became routine. Monetary expansion became a tool not of last resort, but of maintenance. For external holders, this created a dilemma. U.S. debt was still liquid, still tradable, still central. But its role had changed. It no longer represented disciplined stewardship of surplus productivity. It represented the financing of structural imbalance. Returns, once modest but reliable, became increasingly sensitive to inflation, currency dilution, and political constraints. China's accumulation of U.S. treasuries was never ideological. It was transactional. Surpluses generated through export-driven growth needed a home. U.S. debt offered scale, safety, and convenience. For years, the arrangement worked. China gained stability. The United States gained financing. Global trade expanded. But as China's internal priorities shifted and as U.S. debt dynamics worsened, the incentives changed. Holding long-duration exposure to a system increasingly reliant on monetary expansion carried asymmetrical risk. Losses did not require default. They emerged quietly through inflation, currency depreciation, and negative real yields. The reduction of exposure did not happen suddenly. It happened steadily, methodically, and with full awareness of the cost. Selling at a loss was not a failure. It was an acceptance of reality. The loss had already occurred in real terms. What remained was duration risk. This is the critical point often missed. Exits at this stage are not expressions of fear. They are acknowledgments that the system's incentives no longer reward patience. When large holders choose certainty over hope, they are not predicting collapse. They are responding to arithmetic. The modern parallel is not about rivalry or retaliation. It is about alignment. And alignment, once broken, rarely restores itself without consequence. What follows is the phase history knows well. The moment when systems feel most stable, precisely because adaptation has delayed recognition. Late-stage systems often feel most secure at precisely the moment they have become most fragile. Volatility is subdued. Institutions appear confident. Official messaging emphasizes control, resilience, and technical competence. Risk is described as managed, distributed, or fully understood. The absence of immediate crisis is taken as evidence of stability rather than as the byproduct of extraordinary intervention. This is the acceleration phase, where structural weakness is masked by procedural continuity. Policies no longer aim to resolve imbalances, but to prevent their visibility. Markets are supported. Liquidity is maintained. Losses are deferred. Each action succeeds in the narrow sense while increasing long-term dependency. The system becomes smoother, quieter, and less responsive to stress signals that once triggered correction. Warnings are not ignored because they are wrong, but because they are inconvenient. Acknowledging them would require accepting losses that institutions are not positioned to absorb. So risk is normalized. Rising debt is reframed as manageable. Monetary expansion is described as temporary, then structural. Confidence becomes performative, reinforced through repetition rather than results. At this stage, participants learn that the safest position is not accuracy, but alignment with the prevailing narrative. Institutions reward conformity over foresight. Analysts who question durability are dismissed as pessimistic or outdated. The system becomes informationally brittle, even as it appears operationally robust. Capital behavior reflects this tension. Publicly, long-term confidence is affirmed. Privately, duration shortens. Liquidity preference increases. Optionality becomes more valuable than yield. These shifts do not register as crisis indicators because they are rational, incremental, and widely dispersed. No single move breaks the system. Collectively, they change its character. Acceleration occurs not when stress first appears, but when response mechanisms lose effectiveness. Each intervention must be larger than the last to achieve the same stabilizing effect. The cost of maintaining equilibrium rises, even as its benefits diminish. Eventually, the system expends more energy preserving appearance than generating value. When adjustment finally becomes unavoidable, it feels abrupt only because earlier opportunities were postponed. The window for gradual correction closes quietly, without announcement. What remains is a narrower set of outcomes, all more constrained than before. This is not the moment of collapse. It is the moment when collapse becomes a process rather than a possibility. And once systems enter this phase, history suggests that the final movement is no longer driven by choice, but by momentum already set in motion. Every cycle ends the same way it begins, not with villains or heroes, but with incentives. Systems rise when incentives reward discipline, productivity, and long-term alignment. They weaken when those incentives shift toward extraction, leverage, and delay. This is not a moral failure. It is a structural one. The reason history repeats is not ignorance. It is human nature operating within frameworks that encourage certain behaviors and discourage others. Individuals act rationally within the systems they inherit. Institutions optimize for survival. Policymakers respond to constraints that previous decisions created. At no point does anyone need to intend harm for harm to accumulate. What makes these cycles difficult to interrupt is that success itself plants the conditions for reversal. Stability invites leverage. Trust invites dependency. Scale invites assumption. Over time, the memory of constraint fades, replaced by the belief that management can substitute for limits. The system grows confident in its own permanence. China's exit from long-duration U.S. debt is not a verdict on the present. It is a signal about the future incentives of the system. Accepting a record loss was not an act of aggression or protest. It was a recognition that holding exposure no longer served its purpose. The decision was made quietly, within the logic of risk management, not geopolitics. History is filled with such moments. They rarely dominate headlines when they occur. Their significance becomes obvious only later, when the consequences of misaligned incentives can no longer be deferred. By then, the narrative has shifted from confidence to surprise, even though the path was visible all along. This is how transitions happen. Not through singular shocks, but through accumulated decisions that each made sense at the time. Capital adapts first. Institutions respond later. Societies adjust last. Understanding this pattern does not grant immunity from it. Awareness does not halt momentum, it simply clarifies what is already underway. The purpose of studying these cycles is not prediction or reassurance, but orientation. If you're watching for the first time, welcome to the Economy Club. This is where we study the forces that shape history and the patterns that quietly decide the future. Stay curious, stay grounded, and we'll see you in the next cycle.